Jason, it's Fed week,
Yeah.
Today's November 4th. So it was 2 days ago, actually, that the Fed did their meeting. And every
Yeah.
month, the Fed releases their plan. Are they going to raise rates? Are they going to lower rates? Or are they going to do nothing? And they're pretty good at projecting that. But three things happen. They say, we're going to move the rate. And then they do a press release, which is like a written context of their thought process for what happened. And then the third thing is they do a press conference where they actually like interact with the press live.
Yeah.
So the rate went up by 0.75, and that was widely projected. Everyone knew that was going to happen, and exactly what they said was going to happen happened.
Yeah.
So the market didn't respond to that at all. A little bit. They were like, okay.
It was fairly positive.
Right.
At the 75, like the initial, this is what happened. The market responded, the mortgage market responded fairly positively.
Right. As soon and so the whole bond trading market, which is what influences rates on mortgages going up and down, the whole bond trading market is just like waiting on the sidelines for what's called the Fed pivot. And they're waiting for the Fed to say, all right, we've raised rates enough. We're going to stop doing this. We're going to start looking at things in a different way. We're going to be less aggressive and more wait and see. That's
Yep.
the so-called pivot. So they raised the rates 0.75. Everyone knew that was going to happen. And then their press release had some verbiage in it that seemed like
It's very
everyone was like,
supportive of a future pivot. Like,
yeah, they
like
were
a
like,
softening.
next month we might think differently. And that caused the market to swell, and all these buyers poured in. And then they gave their press conference, and then the way they interacted with the press reversed everything. They were like,
Oh
oh
my
God,
gosh.
maybe they're nowhere near a pivot.
Yeah. Yeah. Powell was very, it felt like he was telling a completely different story than, like you talked about, like the notes that came out. The notes were very supportive of this at least forward looking wait and see policy. And he
Right.
very much was like, we're not there. Like, I think he may have even said that like twice. Like, we're not
Right.
there.
Exactly. So we saw a huge surge in bond activity for about an hour. And then as the press conference happened, we saw it all reverse and unwind. So effectively, rates are the same as they are. Inflation's still a problem, and rates are connected to inflation. As soon as inflation stops being a problem, rates are going to come down, and I think they're going to come down quick. I think that's my one takeaway was just like the vibe for that hour was like pretty profound. Like, here comes the pivot. Everyone dives into the market. Like, let's buy bonds. And I think once the pivot actually happens, whenever that is, maybe it'll be December, maybe it'll be January, February, it's probably going to happen. They can't continue acting the way they're acting for much longer. I think 6 months, and then they're not going to start lowering rates, probably, but they're going to stop raising rates and just hold tight, right?
Well, and that's part of what we need. I mean, you and I've talked about this before, right? Like, we don't even need rates to come down. We just need them to be the same for more than 36 hours at a time.
I know, right? I mean, for buyers, it's so challenging. I mean, I had a client who wrote an offer on Friday. We looked at numbers, and then offer accepted over the weekend. Monday morning, the price was a quarter worse. And I was like, let's just lock it at the market. It's not looking like it's going to get any better than this. Like, it doesn't make sense to float. Let's just take that hit. In between when we kind of like pulled the data together in our system and when I hit lock, which took about 45 minutes, we slipped another half a point.
Yeah. And I think
the
that's
volatility is insane. I've never seen anything like this before.
Well, and you've talked about this a lot, where it makes it really hard on the investor side to produce a rate sheet that makes sense when it's changing so often. So like if we could just get some stability, right? Like we
Right.
don't need a full, Fed pivot. We need for them to just like everyone take a deep breath.
Right.
And I think there would be a little bit more competitiveness in, the mortgage market. And I think things could settle. But until we get that, it's just the swings are
I think
wild.
you're seeing the way, so each mortgage company has to manage their own risk. Between when they lock a loan and when they sell it to Fannie Mae, the price could change and they have to sell it for whatever they sold it for that day. And if the market slips, they're hedged, meaning they've shorted the bond market to some degree, that if the market's worse than when they're delivering to Fannie Mae, the short will pay out. And so if you're right, I mean, if you make a mistake on that end of the mortgage side, your company goes out of business.
Yeah. Well, and I think too, I mean, I was thinking about this earlier this morning, actually, with mortgage applications being down as far as they are, every bet they make matters more, right?
That's a great point. Yeah.
When you're taking 300 positions a month and you're wrong twice, no big deal. If you're taking 30 positions a month and you're wrong twice, much bigger deal.
That's true. That's
so I've been thinking a lot about how the myriad of jobs I don't want in the mortgage industry, that is absolutely one of them.
Yeah, that's well, there are always special characters running the capital markets or the secondary markets. They're always unique.
Absolutely. So yeah, I had a couple of meetings during the Fed meeting, but I had it pulled up, and CNBC does a great job of like bullet pointing like every 3 minutes what's happening. And then I had, our MBS chart up, and I was like, this is great. This is all we wanted them to say, blah, blah, blah. And then the conference happened, and Powell went out of his way to make sure that
he brought the hammer.
Were the lasting impression of the, like, regardless of everything that was said before that, that was the lasting impression on the market, was his comments.
So as of November 2022, my view is that rates could still get a little worse and will most likely just stay flat for the rest of the year. I don't know that December will see a huge change. I was kind of thinking we'd start to see a change this month, and now I feel like, we're not close. And so I'm bracing myself for just flat 7% handle, 30-year fixed for the rest of the year, maybe even through January. But I think come January, we may have a whole other data set for the Fed to truly pivot upon. And we're all waiting for that.
Yeah. Well, and the next inflation number is a big one, because it appears to be the first one. Every other inflation number that we've been getting year over year is like brutal, but it's comping to non-existent. So it looks even worse. Whereas this next, number that we get, whatever, like the end of November, will actually be comping a year over year number that had some inflation in it. And
you're talking about the rolling 12-month average, and how up until October, November, December, and I think through March last year, like this inflation story we're in started over a year ago now.
Yep.
And it's like slowly risen through this 12-month rolling average and getting worse and worse. And starting this month, we're going to start dropping off some elevated numbers, which will shrink the
gap.
The annualized number. We'll start to get an actual sense that, okay, inflation is receding, and then the Fed can start. They'll have the, I guess, political cover to change their ways.
Well, and that's the other thing, when the calendar turns in January, we're going to be less, we're going to be 18 months out, 20 months out from an election. And I was having this conversation the other day where right now, biggest inflation since the 80s. That's wildly unpopular if
I
you're a
know
politician.
that's inflation. I always tell people inflation topples governments, and
Yeah.
it's so,
What?
and that's true in America too.
Well, and the only thing that makes you less popular than inflation is a recession, which is also expected to kind of where we're headed. So I
But
still
they're
think,
connected. I think once, so the mortgage industry is certainly in a recession.
yeah,
I would say that most of America is not in a recession right now.
totally agree.
But we're probably heading into one. Well, I think most experts are unanimous that we're heading into some kind of recession. And once that happens, rates are going to come down. Our recession will begin to end.
Yeah,
And I think real estate behavior will start to act with a lot more confidence and clarity. Anyway, that's where we're at right now for the end of 2022. So let's hang on tight. I think that, the elevated rates are still creating that buyer opportunity where, the field is clearing. There's still pretty low inventory, but we've slashed the buyer behavior to the extent that if you can have the courage to stay in as a buyer for the next 60 to 100 days, I think that there's big opportunity for you to get a great price reduction, to get a great,
absolutely.
seller credit, to get repairs, to kind of creep into a slightly better quality house than you thought you might have,
Yeah, absolutely.
even a couple months ago. So
I was
that's
doing
the that's the silver lining right now.
Yeah, I was doing my open house. I'm looking to go to, a 10 or 12 open houses this weekend, and houses that would have never made it through the first weekend have been on the market for a couple of weeks. And it really does. It really feels like an opportunity. Either, again, we've talked about this in the past, if you're a cash trap buyer, to sneak in and get some closing costs paid and things like that. And then also some really, kind of idyllic neighborhoods that likely would have been out of range 6 or 9 months ago. You could sneak in.
The house that I was just telling you about before we started recording, my client who's doing that big rate buy down, they wrote an offer on this house in Happy Valley. I think they're in contract at 850 or 840 or something like that. And they were the only offer. It had been on the market for 4 months. They had reduced price a couple times. When the offer went in, the realtor called me and just kind of like was full court press on me. We might get another offer, like bring a higher offer. And I'm like, I'm the lender. I'm not going to tell you,
Right.
I'm not going to change the offer on this. All I can tell you is why this offer is good. Here's all the features of our offer. Why, if it becomes competitive, I want you to know what features our offer has that your seller can make a good decision about.
Right.
But I will tell you that she did everything possible to make me feel like, oh my God, there's going to be another offer. Oh my God, maybe we should tweak our offer a little bit. But I held my ground. I powwowed with the buying team, and they said, we're not going to change anything. We're not going to negotiate against ourselves. There's no other offers right now, and this is a real offer, and it's a good offer.
Yeah.
And one of the things she said was like, 9 months ago, this house would have been $1 million. And I'm like, great. Like,
you're not wrong. And it has no bearing on today.
I know. I'm like, okay, I'm not going to tell my guys let's buy it for $1 million because it was worth $1 million 9 months ago. But the market is shifting. These buyers are getting a major, they're getting the type of property that they would not have had access to 9 months ago, clearly, right? So that's the opportunity right now. If you can stomach this mortgage market, and if you can structure in some of these affordability tactics that we've been talking about, those people are going to do great, in this market. And a couple of years from now, realize that, they did get a great house.
Yeah. I mean, I think as soon as we see rates settle, even in the low sixes, I think you're just going to see so many people come back to the market that it's going to go back to being fairly lopsided. So, well, this was a lot of fun.
You just don't know when.
Yeah. Love digesting the Fed. And this one was an interesting one. So I'm glad we did this.
Awesome. All right, Jason, see you next time.
All right. Bye, guys.